Valens Research, Uniform Financial Analytics.
And for those of you who don't know MSCI, right? MSCI, they make, I would assume since everyone here works in investing, you do know MSCI, but they make indexes. They are a data vendor that people use to be able to do risk scoring for their portfolios. They provide data and analytics for people to be able to use for any number of things in the investment world. And what's really telling about MSCI is, right, you would assume because of how essential they are for people to build ETFs, for people to show, asset allocators how good or bad their risk controls are, for people to be able to do their own diagnostics on their portfolios they're potentially going to invest in, and all the other things that they do. You'd expect because of how essential they are to the investing world, and also because of how they're getting more and more important based on what's going on with ETFs and passive investing booming and how they are central to all that, you'd expect returns to improve. On an as reported basis, though, you'd see a pretty weak, an average at best, and middling and flat return that's around 13% the last couple of years. You would say, wow, considering how integral they are to the new investing world of passive investing and ETFs, they've done a pretty poor job of monetizing that. Looking at uniform accounting, though, what we see is totally different. What we see is a company who's seen ROAs expand from what were 29% in 2017, already impressive levels, all the way up to 50%. It's almost doubled its profitability the last few years as ETFs and passive investing has gotten more and more relevant, as leveraging their kind of analytics has become more and more relevant. As all these things have happened, it has gotten more profitable, not had steady state profitability. And that also helps explain why it's trading at a 42 times multiple. On an as reported basis, you look at a company with middling and flat returns and you go, why on earth is the market paying a 50 times multiple for this business? On a uniform accounting basis, we can see we've got a company with accelerating profitability and strong opportunities for growth. No wonder it's trading at a high multiple. Now, that doesn't mean that it's a buy, right? Because as we talked about before, these white bars show us what the market is pricing to do in the future. And at a 40 times multiple, right, the market's already pricing this company to continue to see ROA expand. It's forecast to be 50% next year. The market's pricing ROA to double again in the next 5 years, just like ROA doubled in the last 5 years. So the market probably has this one right. But right, this says to us, hey, maybe the market gets it and it's something to just stay away from. It doesn't say, wow, we've got a low return business with high multiples. We should short this company in the ground, which is what as reported metrics would tell you to do.
Valens Research, the world's leading source for uniform financial analytics.